Okay, so welcome everyone to this second roundtable for this our annual meeting of Zonavalue. In this round meeting, we are going to talk about value investing in this new era after this crisis. For the people who don't know who is with us, we have Mefaber with us, is CEO of Cambria. He has the writer of several books of investment and is one of the investors who knows more about portfolio construction and asset allocation. Hello, Mev. Thank you to be with us.
Great to be here. Sad not to be here local in Spain, but good to be here virtually nonetheless.
We have also with us John Boyer, is chairman of Boyer Intrinsic Value Research. It's one of the oldest research firms in Wall Street, established in 1975, and is one of the investors who know more about value investing and who has more stories about value investing and how value investors work. Hello, John. How are you? Thank you for being with us today.
Thanks for having me, and I echo the sentiments. I wish we were doing this in person, hopefully next year. But for this year, this is certainly good enough.
I'm sure next year, all of them, we are going to be in Madrid taking a Spanish food for everyone. So we have also Tobias Carlyle, founder and managing director of Acquires Fund, writer of the bestseller Deep Value, one of the best books of value investing, and one, for me, in my opinion, that everyone has to read to understand factor investing. Hi, Toby. How are you? Thank you for being with us today.
Hi, Lorenzo. Great to see you. I've got my Spanish translation of Deep Value here that we worked on together. Very excited to chat with you today.
Great. So we have also Diego Parrilla, is manager of the fund Smart Gold in Quadriga Asset Managers, and is also the writer of the bestseller La Madre de Todas las Batallas with Daniel Lacalle, and is one of the managers in Europe with better background in commodities. Hi, Diego. How are you? Thank you for being with us today.
Thank you for the invitation. My pleasure.
Also, we have Michael Morozzi. Michael is CEO of Savers Capital Advisors, a RIA based in Miami, and is a portfolio manager also in Mafre America with a spectacular background. Hi, Michael. Thank you for being with us today.
Great to be here, Lorenzo, and great to share the panel with all these other very talented investors.
And also we have Eduardo Ripoller, is head of institutional business in Mafre EM, and is the guy behind several of the most celebrated funds launches in Europe last year, as a Mafre US Forgotten Value with Boyer Research, and good governance as well. Hi, how are you, Eduardo? Thank you.
Hello, everyone. It's a pleasure to be here. Thank you, Lorenzo, for organizing this event. It's a pleasure to be here with some friends, and let's see if we can have a wonderful meeting together.
Great. So for starting, I would say that one great philosopher, Spanish philosopher, Ortega y Gasset, said that tell me what you pay attention and I will tell you who you are. And I have a question for John Boyer about value investing, and it's what value investor is paying attention for, and if you can say then who are a value investor in this way.
So what am I paying attention to, you mean?
Yeah.
I pay attention to
investor. Yeah.
I pay attention to everything. I read everything I can. I listen and form my own opinions. But for what separates, I think, a good value investor is to try and filter out the noise, the unimportant factors out there. I mean, there's obviously a lot of noise now with elections, geopolitical uncertainty, coronavirus. Not to say that they're not important, but what we're doing and what we're paying attention to is each one of the businesses we're investing in and how are they going to be 2, 3, 4 years from now under a normalized environment. So you can't get caught up too much in the day-to-day. That's what I think most investors fall into, that trap. It's too easy to follow the major news networks and get caught up in the day's headlines when most of the time nothing significant happens on a given day.
So, and these days, value investing, here in Spain, we have that value investing has been used as a brand for selling a lot of things. And a lot of people is saying, I'm a value investor. I don't know if this is happening in America as well, but sometimes we don't know really what a value investing is or has to mean, or what is the focus of value investing, because, it is too much used for too much things. What do you think, Toby, that we can define a value investing for, say, okay, this is value investor and this is not a value investing?
That's a relevant debate right now. There's a very large debate over whether lower multiple investing can come back, or whether it's now going to be, are we always going to look at growth rates and reinvestment and assume that extremely high rates of growth leading to an intrinsic value way off in the distance, that's something that we're going to try to pay up a lot of money for not very many cash flows now. So I think it's the key question at the moment. It's definitional for value investors that they have to decide whether they will chase those very high rates of growth, which have tended to mean revert in the past, or whether they will look for nearer term cash flows. For my part, I'm in favor of the nearer term cash flows, but that has not been a great strategy since about 2018, 19, and most of this year. That's a strategy that has lagged the market, whereas the more growth that you've built into your valuations, the better you've done. So I think that at some stage, there's a return to more traditional value investing, but I'm just expressing my bias up front so everybody knows where I stand. Okay, because, as the big guy of value investing is Warren Buffett, and Warren Buffett has changed, his point of view about what is value investing and what is his own investment in the market during several times. He has done it several times during his life. And sometimes we say, okay, changing as an investor is not good because you can't change with the environment. But sometimes changing if you are wrong is right, because you have to change when you have a mistake or you are doing a mistake. So this is a question for Diego, how to measure the changing or not changing in your career, your philosophy or investments, and what can we say this is a bad change or a good change during the philosophy of investment?
Well, I think to actually link my answer to the previous two questions, I think, and I'm probably the odd one out in this panel because I'm a macro guy. I think the big issue to Toby's point is I think we're in the middle of a paradigm shift from a macro perspective. And I think this all comes down from artificially low interest rates. And once you understand that the current macro setup is 100% artificial, meaning interest rates are by no means the fair reflection of where they should be according to all measures. What we've done over the last decade, in my humble opinion, is we have witnessed the transformation of risk-free interest into interest-free risk. And this dynamic where the 10-year bond, for example, used to pay you 5% with no risk. So you could just put your money there, thank you very much, and year after year you would get 5%. And then on top of that, if there was a crisis, that same 10-year bond yields would go to zero and you would make 50%. Meant that you had this conventional portfolio construction model, the 60-40, was actually pretty well balanced. You had the strikers, you had your defenders, and in that sense, you were working in a true balanced environment. The third implication of this transformation in rates is that, to Toby's point, if you are valuing assets based on discounting at 5% nominal interest rates, the PV of $100 in 10 years was roughly 62 cents. In 20 years was roughly 36. In 30 years, roughly 21. In a world where interest rates are zero and you have that growth, they're all 100. and we've created such ginormous bubbles that they're now too big to fail. So the idea that we could somehow normalize monetary policy and bring interest rates back up to 5% is science fiction. And to that extent, the rules of the game have changed from a world where inflation would be met with higher rates. And now we're in a situation where we're going to have both inflation and zero rates. And so, to your point, Lorenzo, I think the rules of the game have dramatically changed, and there's massive questions, as Toby was pointing out, which way you go. But I think we need to understand that we are operating in a highly distorted, manipulated world where these bubbles are now too big to fail, and therefore that mean reversion he was talking about may ultimately never happen, because I think just as I summarized the last 10 years as a transformation of risk-free interest into interest-free risk, I think the next 10 years are the transformation of bubbles too big to fail into inflation, or perhaps more accurately, stagflation. And this is a very difficult dynamic where we all need to cope with, and where, if this was a video game, it's hard enough to play level 1, which is try to make money in nominal terms. Try to make your $100 go up. Level 2, which is coming very fast, is you need to beat in real terms. So yes, you made 105, but inflation has cumulatively been 20%. You lost out. And third, which is coming as well, is you not only need to make this money in real terms, you also need to make it after tax. And then it's just the governments and the central banks are either taking the money away from you through inflation or taxes or both. And this is really a very big change in the name of the game. And I think we have to adjust, and it poses big risks and opportunities for value investors as well as macro investors.
I totally agree with you that a lot of things have changed in the environment, and sometimes you have to change with it, and it's difficult to see how to measure things in this new environment that we are going to live with. And what do you think, Merv, that has changed the portfolio construction in this new environment? How much of value investing do you think that we have to add, or taking into account in this portfolio construction that we have to face for the next years in this situation that Diego has explained very good, and also not only in United States but also worldwide? How do you see this situation?
When I think about value, and I'm a quant, so I tend to think of it a little bit different than most, but there's two parts. We love to focus on value just on the cheap stuff, which has consistently been getting cheaper. In some places around the world, getting to the point where we think it's multi-decade cheap relative to other markets like mine, the United States. And that plays out over really long periods. I mean, these regimes, for the historians out there, can easily take 10, 20 years. And most people don't want it. They want it now. Give me the results today, this week. And in a world of sort of Robin Hood mentality, that's just not how it works. Many of you have heard me say this, but for the new listeners out there, I used to tell people when they asked me about an active strategy, and they asked me about even an asset class, it could be value investing, it could be stocks, it could be gold. How long do they need to give this? We'll talk to people about, hey, Meb, your fund isn't doing that hot this week, quarter, year. How long should I give it? I'm going to give it about another 6 months. And I used to say 10 years. and they would laugh nervously, and I would just pause, and now I say 20, in which point the conversation ends. They walk away. It's not a particularly useful cocktail hour topic, but looking back in history, as far as assets, even there was a period, let's call it 4 months ago, where in the United States, there is no more ironclad belief in all of investing than stocks outperform bonds. I don't know a single person in the world that doesn't believe that over time. But in the reality, you had a scenario where stocks had the same performance as the long bond in the US for 40 years. Not 1 year, not a quarter, not a decade, 4 decades. That's a long time to wait, right? So thinking about value investing, I was going to quirp in, but I muted myself. I said, Toby's book at some point, next edition, may be Deeper Value or Deepest Value. We can keep putting these out until value has its turnaround. This week, not to jinx anyone, it's starting to look better. But these things take time. And there's the two parts that I wanted to talk about when I initially mentioned this was, it's not just about buying the cheap stuff. It's also about avoiding the really expensive. And there has been countless study after countless study that buying the really expensive stuff is just not a good idea. I mean, that's the technical way to put it. It's just really dumb. And so examples in history, my favorite bubble, Japan in the 80s, for the older crowd out there that remembers this, just now getting back to the highs of the Nikkei bubble in the 1980s. That's 3 decades. Japan is a top 3 world economy. It was the biggest stock market in the world. And so people can lose their mind for long periods. And historically, avoiding the really expensive stuff is just as important. And so right now, when we look top down, the bad news is, there's some expensive stuff, pockets of mania. The good news is there's a lot of cheap and simple ratio-based analysis, which, going back to the earlier comments on what works, what has to change, these things evolve, but looking super big picture, super long term. So when we redo this in 2030, 2040, and we all come back, we're in Madrid, maybe we're all holograms teleporting. I don't know at that point, taking SpaceX or Virgin Galactic, be there in an hour. We can say, look, see, value investing was such a great idea, but it often doesn't turn on a dime. So that's the challenge of our world. But it doesn't just apply to value or stocks; it also applies to entire asset classes as well.
And Michael, there is right now a topic that everyone is talking, that is growth against value, or if you have to buy growth or value. May Faber has said right now something that is nice, that is not only buying cheap, but avoiding the expensive. What do you think about this controversial about growth is value? If this is really a controversial or not, because maybe there is not such a controversial, and growth is value and value is growth sometimes, But what do you think about building a portfolio in these times? And what do you think about this, avoiding the expensive or buying the cheap?
No, I think that's a great point. And I think sometimes we get a little bit confused and maybe create some false dichotomies out there, because stocks that have growth characteristics, being sustainable top line growth over a number of years and reasonable expectations that growth may continue, can also have value characteristics as well. Perhaps not in the kind of the pure kind of factor description, but maybe more on the Warren Buffett description of very defensible businesses, moats, network effects, the types of things that help fundamentals persist over longer periods of time. So that's one thing. I mean, I would say perhaps this dichotomy between value and growth is perhaps not as clean cut when we start talking about individual securities and when we start talking about fundamentals at the individual company level. So that's one thing. What I say secondly, I think the good thing for everybody on this call is the the competition, I think, is going to get a little bit easier going forward. And by that, I mean, the index, I think, over the next 10 years is perhaps not going to be the challenge that it was over the previous 10 years. And so I think that's good news, and so what I would say is, kind of returns to active management, as inflation expectations maybe start to tick up, as maybe this secular decline in interest rates at least starts to bottom, if not reverse somewhat, that creates, opportunities for dispersion. That creates, some of these correlations, these cross asset correlations that are at, multi-decade highs. Those will start to unwind a little bit. And so that creates, opportunities just in general. And so it might be, the dynamic going forward, might be that, it's not so much investors just want beta, hey, give me the Vanguard, give me the levered, SPY index fund, but it's like, no, hey, give me, some wise, kind of dynamic asset allocation, and give me exposure to some of these, kind of more idiosyncratic, intrinsic, exposures, that, going forward, might be the way, might be the way to outperform, and kind of address that, kind of those multiple issues, kind of that video game effect that Diego was referring to, with the nominal returns and the real returns, and doing that through, probably a little more eloquent, a little more sophisticated, kind of asset allocation.
And of course, there is a tendency right now that is investing in ESG, and a lot of people is investing like that. And Eduardo, I want to ask you, why in your political, in your company, you are investing in ESG as a tendency that you bet on? And do you think that you are going to underperform with this kind of investing? And there is, as some people is saying, that you can have less volatility and also more profitability when you are investing in this way?
Well, that's a good question, Lorenzo. First of all, we are doing this ESG investment is because it's a mandate from the board of directors from the company. Let me give you a brief explanation of Mapfre as an insurance company, and all the social responsible investment. It's in the company since it's been established in 1964. So right now, the corporate social responsibility has been transformed into sustainable investment. And from the asset management company, from the division from Mapfre, we have the mandate of creating these products. Michael knows perfectly. And the idea is that we have to not only try to prove and to sell to the market these new ideas of ESG investment, avoiding greenwashing, it is critical because we cannot be part of that, but also we have to go for long-term investment. And by reallocating all our assets that we are doing now, as Diego was saying, with the zero rates and with inflation, and as a big insurance company, we are talking about a company that is now currently has more than 70 billion euros in terms of financial assets. We have to transform ourselves. We have to reinvent ourselves. I mean, it's impossible to wait for long-term, for higher interest rates. So what we're doing now is a different asset allocation. We're going through different strategies that they have not been before in the company, like value investing, by the support of Jonathan Boyer and the US Forgotten Value, by ESG investing. So all the things that we're doing is just to reallocate everything with a long-term vision. We are an insurance company. We are not going for a tactical result. We're going for a strategical result. And by knowing that we are a really conservative company, and our allocation in terms of equity is no more than 7-8%, probably in the short term we will rise that over double digit because we need it. I mean, it doesn't make sense to go anymore for fixed income. So ESG, it's something that we believe is going to be here for the long term. In the short term, probably we'll see some impact in terms of bad image of some cases that they will fail. They will fail in the terms of explaining to the market that they are the most green investors, and what you can prove afterwards is that they are doing something that is not, it's a fake. But in the case of an insurance company as us, we have to do it like this. This period of time from coronavirus, since the 24th of February, is the period that we are measuring. It's proving that this type of funds, by using value investing, using balance funds, using good governance funds, they're working really nice, these funds. And instead of using track records, old track records or backtesting, we're using real data. And this real data is proving that performance is nice, volatility is less. So we believe that this type of indicators used in a traditional investment, using in deep value, in value investing, in growth, they work. I mean, it's just a matter of how to measure this in those companies and use those indicators to select the companies properly. Yeah.
Okay, I have a lot of questions. Toby, do you think that value investing is at the end a conservative way of investing? Because it seems like it is in one way or another. And do you think, as Michael says, that next year's value investor, we are going to have easier markets for making money than in the past?
Yeah, I agree with Michael's point that the index seems to be extremely stretched at the moment on any sort of cyclical, long-term cyclical measure like the CAPE, the Shiller PE, or the Tobin's Q, or Buffett's favorite measure, the total market capitalization to gross national product. On any measure like that, the US market in particular is very, very stretched and value is very beaten down. So I would think that the easier bet to make would be value over the market. I'd hesitate to say that it's going to be easier to go through it, because I suspect there's a lot of volatility along the way to get there. I agree that value tends to be a more conservative approach to investment, because you need to tie the positions that you're taking to the fundamentals at some stage. So there's a limit to sort of how much you can pay. Even the very growthy value guys, they might balk at free cash flow yields that are sort of approaching the 10-year. Although they seem to be sort of willing to pay for some of these very big companies. The argument goes, well, you get a free cash flow yield that's approximating the 10-year in the States, and it's growing at a very high rate. So that seems to be a better option. But at least it's tied to something. If you look at some of the growth companies, then I think the growth investors are very like, Buffett gave that great analogy of Cinderella at the ball. And at midnight, everything turns to mice and pumpkins, but there's no hands on the clock. And I sort of feel like that is where the tech investors are at the moment. Everything's going up. And if you're a price trajectory investor, everything looks really good. But at some stage that breaks down, and then I don't know what you base your decisions on when that goes backwards. And so that's something that we've seen in the past, that the crashes for the momentum and the glamour, the very expensive stocks, tend to be pretty nasty. So I suspect that happens some stage around here. I hope that value has a little resurrection at that stage. I think that there are fewer and fewer of us who believe that can happen, but I am one who believes that it can happen.
What do you think about that, John? Do you think value investing at the end is a conservative way of investing because you can, where are you investing, and you can avoid this tail that Toby has shown, that Warren Buffett said? And what do you think about this index situation and the possibility of having better years in the coming years?
Sorry. Can you hear me?
Yes, yeah.
To answer the first question, is value investing a conservative way to invest? As someone who grew up with, my father's, who started our firm as a value investor, to me, it's really the only way to invest. I don't really know any other way of doing it. To me, buying something for less than it's worth just makes sense. Buying something because in 3 or 4 years, it's going to grow at X% a year based on that theory alone is, to me, much more risky. But you have to know what you're buying. You have to really understand, I really dislike the term value investing, to be honest. I don't think, growth investors try to lose money. I think you have to be opportunistic. You have to, some things are going to have statistically cheap PEs that are great things to invest in, and other things are going to be expensive, but they have valuable network effects that aren't really reflected using traditional metrics. So you have to be nimble. You have to be, intellectually curious, and you have to really do your homework is a kind of a longer way of answering that. In terms of indexing, I mean, it's getting to a point where it's absolutely ridiculous, especially the index concentration. Although I would warn that this doesn't seem like a 1999 period, because a lot of the names that are leading the market are not insanely valued. Some of them are, like maybe an Amazon, et cetera, on a PE basis is quite expensive, but nowhere near the way the Cisco's, et cetera, were selling in 1999. So my best guess, or our best guess, is over the next 5 or 10 years, these stocks that have been the leaders, they'll do okay. They'll muddle along. But I think value, which has had its worst performance probably ever over the last 10 years, will, have a resurrection. I mean, obviously, clearly I'm biased in that thinking, but I believe it to be true. I just don't, and the law of large numbers kind of also backs it up. There's only so big an Amazon, et cetera, is going to get.
I like when you said, I don't like value investing, I like opportunistic investing, because I think this is a very nice name to name that you are looking for the opportunities that the market is giving you. That this is what value investing we're saying that is. Mev, I want to ask you, you say, I'm not a value investor and a quant investor. How do you define your way of approach as a quant investor? And which is the difference between quant investor or value investor that in your ideas?
Well, quant to me, and I'm not talking super high frequency trading sort of ideas that people think about when they watch the show Billions, or doing some super difficult algorithmic ideas. To me, at its very core, just means rules. So for me, and for many investors, the biggest challenge is, of course, the behavioral side, the emotional side. I talk to investors every week who sold all their stocks in 2009 and never to re-enter again, and then probably going to rinse repeat that this year. And so the behavioral emotional side is, of course, the hardest. So when I say behavioral, a simpler way to think about it is just guardrails, and having an idea of, listening to Jonathan talk about some of the challenges of value investing. I would add the biggest trait you need is propensity to handle pain. And so 2020 is no different. These times can be very trying. So the first thing that people can do, of course, is study history to at least understand the times that it's been bad in the past for anything. For assets that go many long periods with underperforming and huge drawdowns. Talk about stocks. Say, look, they can go down 80%, no problem. And we're talking about indices here. It's happened almost everywhere. And I think that's a challenge for a lot of people. But even then, you get to the point where the future is going to be even worse at some point. By default, your largest drawdown, the biggest pain is in the future. 2020 has been such a great example of that, as a reminder to people that normal market returns aren't extreme. We had the fastest ever from all-time high in the US to bear market, and vice versa. So we love coming up with this fake client note that says, it's okay, clients, we've never seen this before. A lot of people like to project back to history and say, look, we've seen this, it's okay. Eventually you're going to have something where you haven't seen it, where things like long-term capital, right? They go way outside the norms. But we like to say that market returns, normal isn't average. And a great example is always the expected returns for stocks that the strategists each year, they group around this sort of historical 8% return. And that sort of 0 to 10% range only happens like 1 out of 5 years. It's really rare. You have the big up years, the big down years, and everything in between. And so the biggest challenges of being a quant is you sit back and say, okay, at least I know what to expect. I know the foundation. I know sort of the guardrails. And that means a lot, because you can kind of put yourself in perspective. even with the knowledge, you have to be a little bit of comedian that things are going to be even weirder and different in the future. And hey, look, we still got 3 months left, so I'm not jinxing us because 2020 is not over. Things could go all sorts of different directions. But for me, it is more than anything just having rules. So the example we give in the US, historical valuations, 10-year PEs, you can take this back to the 1800s, around 17. They've been as low as 5. They've been as high as 45, right? And that's just what people are willing to pay. That's all. That's just a psychological multiple people are willing to assign to stocks. But the historian has to say, well, in Japan, they've been as high as 95. So there's the possibility, and we're at 30 right now, which is high, but to get to 90, you have to get to the highest they've ever been, you got to go up 50%. To get to 90, you have to triple. So things can go way weirder than they are now. And you have to hold that in your head, the possibility. And I think for most people, and I'll wind down here a second, we did an article in March that said, look, this is kind of unprecedented. You have to at least prepare for the bull and the bear case. And we kind of laid out, here's what could happen for the bear case to transpire. Here's what could happen for the bull case. Said, and this is in March. I said, you have to prepare for the possibility stocks hit all-time highs by year end in the US. And as odd as it feels, here we are. And that's the wonder and the challenge and the agony and ecstasy of being an investor, in particular a value investor, because the future is always uncertain. We try to put the odds in our favor, particularly as a quant, speculator, gambler, but anything in the future can happen too. And the biggest takeaway is to stay in the game. If you don't have any chips, you can't bet. And so to at least mentally prepare for the bad times, I think is important.
I think, yeah, if I could just interject here just 1 second, Meb, I think you made a couple great points there about having the rules and again, just, kind of staying in the game and kind of you pairing that with, John's references to, kind of value investing being good investing, being quality investing. I think one way to keep, value investing as a conservative discipline is to have rules around kind of what you're willing to accept in terms of, for example, leverage. Cheap companies with a lot of leverage, can go very badly. Cheap companies with not a lot of leverage have less ways to go wrong, and it puts you in a position to let time kind of work in your favor. But again, that company needs to be around. That company needs to be around without having totally diluted its equity base, and so I think having rules, say, for example, around leverage and around kind of the the sustainability of a balance sheet kind of helps an undervalued company kind of be able to last and kind of make it through and have that kind of value gap close over a certain amount of time. But it's all about kind of balancing that that risk of again that kind of permanent impairment of capital and letting time work in your favor.
I'm totally agree about rules, and that if you have rules, at least you know what is going to happen, and what are you doing, and you can avoid a lot of problems. And of course, you can have the mindset to go through the bad situations that are going to happen. Diego, how are the rules to approach to the commodities that you are using? Do you think that in commodities, the only way to approach it are a macro analysis? And of course, what is happening with gold? Do you think that this has a correlation with the possibility of having inflation appearing in the world?
Sure. I think one of the, as a commodity guy and having spent a lot of time on the energy markets as well as precious metals, and going back to the point on rules and prudent risk management, I think we need to understand, as Michael said, that leverage is probably the number one cause for financial bankruptcy. But this happens in multiple levels. The first one you're talking about is just the leverage within the company. The second one is obviously the leverage that you might take yourself buying a Delta 3 or whatever, LTCM type. So that kind of doubles. But then one thing we focus a lot on is what I would call hidden leverage, and which effectively leads to what I also call false diversification. And this comes from the fact that, to use the concept of anti-bubble, which I coined in my second book, things like volatility and correlation can be artificially low and give you a sense of complacency. And so what happens is every crisis, putting my nerdy engineering hat on, if you think about fluid mechanics, the world has two regimes. You have the laminar regime when things are linear and predictable and things happen in a given way. And then you go into crisis mode and then things become turbulent. What it means for portfolios, and I think Q1 2020 was a very good example, is we need to remember that this move happened from the VIX around 10-11. So you are, which is grossly artificially low, right? This happens because of complacency, because of the perception of low risk, but it's a bit like driving a car at 200 miles an hour when the speedometer says 80. If you ever had an accident, what do you feel? Well, I'm sorry, mate, but you feel whatever speed you were running, regardless of what the speedometer said. And I think to Mev's point as well, that kind of discipline, and unfortunately, when volatility explodes, and I think 40 to 50 is a good point where fundamentals don't matter anymore, correlations tend to polarize. And so what you saw is you thought you were diversified because you had a bit of value, a bit of growth, a bit of emerging markets, a bit of whatever. And turns out it was all the same trade and everything collapsed. So I think in terms of those ideas with respect to rules, I am ultra conservative. We don't run any leverage in linear form. We don't even run long short, which is another way of being of hidden leverage. Good luck to those that were long for short Tesla. Okay, or when you look at options, which we are a pretty large player in the option space, we only buy options. Trust me, it's very simple to sell options. It's not that difficult to sell an option and collect some premium. These are self-imposed measures that make sure you will not blow up under any circumstances. And to Mev's point, you have to stay in the game. I mean, if you have no linear leverage, no long, no shorts, and you only buy options, this is the safest way in which I know I can stay in the game no matter what. And so I think this dynamic is part of the reason why, despite sounding very conservative, we're up 45% in Q1, right? Best hedge fund in the world in February. So in that sense, conservative, being no leverage, no outright shorts, ensures that you live through this crisis. To your point on, and this comes from obviously commodities background. I mean, some of you may understand or may have followed things like Brent and WTI. These are almost chemically, from a chemical perspective, identical commodities. And people would say, look, I'm going to trade the flat price. And as a trader, I'll do 100 lots. But then when you trade the spread, whether it's Brent TI or even time spreads, people get very comfortable with the fact that they're highly correlated. Well, guess what? People put a position of 1,000 lots and they say, how bad can it go? Well, I always tell them, well, it's like the Tesla Ford example. Okay, how bad can it go? I'm going to buy some puts and I'm going to finance them by selling calls. I always say, dude, you're not financing anything. You're long puts, you're short calls, and you just blew up. So this idea of thinking in zero premium terms, having these shorts means that when correlations break, people blow up of these trades in Brent WTI because they put 1,000 lots per leg thinking they had very little risk. And that's your LTCM trade, right? Correlations break and vol goes. So I think in that sense, this is all where the commodity background comes. And ultimately, fundamentals matter. 2 + 2 = 4 in terms of supply demand. But I think the inflation story is critical. And as I pointed out earlier, I think we need to understand that central banks and governments have no choice. They're facing bubbles that are too big to fail, in my opinion. And the only way out here is going to be by pushing the limits farther of monetary and fiscal, which ultimately exacerbates things like currency wars and trade wars and others. And therefore, I think inflation is going to be an absolutely major driver of markets. And we're still in that phase where, we've been fooled by the perception of and the risk of deflation. But I think it's very important to understand that inflation is not about the value of my house went up, the value of the cost of bread went up. That's not inflation. Inflation is about the value of the money that you use to buy your house or bread going down. And it's as simple as that. And when you think about the trillions and trillions that are being printed out of absolutely nowhere, and the dilution of the money, we're creating this force that is offsetting very deflationary dynamics in the short term, such as unemployment and technology, demographics, and bubbles, overcapacity. All these deflationary expectations are being, that vacuum of deflation is being filled by trillions and trillions of money printing. And this is something that I think it's going to come and bite us. And therefore, I think gold is the ultimate anti-bubble of the bubble in fiat currencies. And when I had that article in the front page of the FT, gold was 1,200, and I was calling for 3,000 to 5,000 gold within 3 to 5 years. It sounded like science fiction. I think the dynamics that drove me to make that forecast have been dwarfed. I mean, they are nobody could dream of some of the things we're seeing today. And this is back to my first point. I think it's dramatically impacting the markets, the valuations, and everything else. So I do think inflation is a critical aspect, and I think risk management and the rules that Mev and Michael were talking about are absolutely critical. And you have to have, first and foremost, these rules to make sure you stay in the game. And unfortunately, these rules are changing. I'll finish with one of my lines, which I think rule number one of the investment game is they will change the rules. so good luck with that.
Okay. Eduardo, how do you think about in your company about inflation? How do you feel comfortable in a volatile environment that we are going to live with this line of investing for a 20 years forecast that you are doing? Because, Mapfre has a 20 years forecast for the investments, but we are going to live a very volatile environment. And of course, we or Mapfre has to look for, or everyone has to look for, these rules and this way of avoiding problems during these crazy times that we are going forward. So how do you see that, and how do you face that in your approaching to the investments?
Well, first of all, we have to split between two different, the investment ideas are the same from Mapfre portfolio or balance sheet for our going through all the value chain until the retail investor. First of all, all the decisions that we make are always related with our seed capital that we invest in the funds. For example, in all the UCITS funds and all the alternative funds, the first investor, the anchor investor, is Mapfre with its own money. So it's something that proves that we are over there to stay in the long term, knowing that in the short term we're going to have these volatile issues and these problems with the different cycles of the economy. We know that from that point of view, the investors, the retail investors, are asking us for a more growth or tactical funds. So that's where we're trying to manage in terms of trying to educate them and separate between the investors that they're looking for the short-term investment, knowing that they can play with that volatility. We don't like that, but we know that we have to do it because the investors are asking that for that. So we have to be in the first quartile on the performance tables. We have to be at the top. We don't want to be in the last quartile. We want to prove to the market that we are constant in our investment. So it's not easy. It's not easy for an insurance company. before 3 years ago, 4 years ago was really easy because you were with the govies, you invest on govies, and that was fine for the long term. But now you have to take some risk. And by taking that risk, you have to go for short-term exposition. And that's what we are doing in our equity funds and with long-term view. So it's not easy to explain that, knowing that, listen, I'm going to be here for long-term. I know that you are not going to be here for 20 years for the private investors, but taking account that my investment is a seed capital that is going to be over for a long time. So it's not easy to play with short-term, rather for a company that the milestone is to go for long-term investment. UCITS funds are something that are over there to use it in a tactical way. Now we are starting to go more for alternative investment. Actually, we are launching today. We were in the first event presenting our infrastructure fund together with Macquarie, and that means that's because we are facing a different long-term view. So we're trying to avoid between the usual and traditional funds, the UCITS funds, and trying to go for that long-term investment with the alternative ones by using private equity, by using infrastructures, by using private debt. But for the short term, for those investors that are looking for liquidity, we know that we have to play the same game. But the message is that from the long-term investment, from the long-term point of view, from an asset management as Manfred, we're going to stay there over the time. Even we have volatility, even we have more increase in interest rate, a decrease in interest rate, more inflation, less inflation. So this is the only message that we can provide to the market. I mean, we are solvent. We have a solvency ratio. We have to keep aware of that. We have to take in mind that our investments are to fix and to match all the insurance policies that we have. So this is a role that we have to play different than the independent asset management companies, and that's a critical issue for us. And this is a target, a goal, a challenge that we have to achieve, and hopefully we will do it in the following years.
Okay, I wanna recover one thing that Michael has said, and has said something about quality. And Toby, what do you think about quality measures inside the value investing to avoid problems in the next years, quality in the companies that we are selecting? And what do you think about this kind of rules, or how do you see the idea of having great rules to avoid these kind of problems that we can face?
I've been nodding along in agreement with everything everybody's said so far. Quite honestly, I don't think that you can separate quality and value. I understand that they are separated as factors from an academic perspective, but I wouldn't buy something that's undervalued on a ratio basis without having some of those quality factors. You need cash flow, you need cash on the balance sheet. You know, ideally the company's buying back stock too, because that means that management is at least aligned in some way with the shareholders. So for me, the question is how much quality can you buy for each dollar that you invest, rather than sort of how much value can you buy, because value seems to me to be it is just, you know, book value is a measure that you can find written down, but I don't know necessarily what that means for any given company. Clearly, it's meaningless comparing the book value of a tech company with the book value of a bank or the book value of a miner. They're vastly different businesses. So I think they're inseparable. I'd just like to say something to Diego's point earlier, which I thoroughly agree with. I think that if you print an enormous amount of money globally and you reduce the amount of goods and services that are being provided over a period of time, which is essentially what we've done, it seems to me that it's impossible that you don't get enormous inflation following that. Impossible is a very strong word, and I've been in the markets for long enough to see lots of impossible things happen. So I'm not necessarily saying that won't happen, but I think very likely that is the case. And if that is the case, and it looks like the 1970s, we go into a Japan-style deflation that lasts decades, in that scenario, the only place that I want to be is invested in value. So I just leave that as my final thought.
Okay. And Mev, we are going to the end, so I'm going to ask you a question just for the future. How do you see the future? How do you see the elections that we have right now, and if they are gonna impact to the market in one way or another, do you think? And how would you construct your portfolio for the next year if you have to do it right now?
Oh boy, I have some pretty non-consensus views here, so buckle up. First of all, there's a nearly 90% accurate indicator of who's going to win the U.S. presidential election that goes back 40 years. And if you go back to the 20s, it's still like 85% accurate. And it's simply, is the stock market up or is it down? You can do 3 months, you can do 12 months. But 3 months in particular has like a 90% accuracy rate. And we wrote this last time before the last election. And I said, Team Clinton better start buying S&P futures if they want to win this election, because meaning if the stock market's up, the incumbent party stays in power and vice versa. So Team Trump seems to be looking pretty good right now. Last week, market's been up. So I made a offhand joke yesterday for the conspiracy theorists out there. I said, I wonder who's been buying all these calls. Maybe somebody's trying to, maybe it's not SoftBank. There's all these Robinhood traders buying all these calls this summer. Maybe they know better. But with that having been said, I wrote an article 4 years ago called How the Clinton or Trump presidency will affect your investments. And the answer was that essentially people are looking at the wrong bogey, of course. The famous example we always give was, what are people afraid of? My wife hates sharks. We live in Los Angeles. The lifeguard says every single day someone sees a great white shark. They're babies. They never bite anyone. So, but he says every day someone sees one. I don't ever want to see one, but people are afraid of sharks, and rightfully so. They're scary, but they never eat anyone. Maybe down closer to where Toby lives in Palos Verdes they do, but not here. And so, but what are people not afraid of? What kills the most amount of people every year? Number one is mosquitoes, right? No one's afraid of mosquitoes. Number two is other people. And like within the top 5 are dogs, man's best friend. And then rounding out the top 10 are like snails, worms, all sorts of other stuff. And the point we were trying to make is, usually what people are afraid of is meaningless, and what people actually should be concerned about has a great impact. And so the really unsexy things of fees and taxes and basic blocking and tackling of the rules, like we mentioned, I think for the vast majority of public market investments, people, whatever their allocation is, and mine is vastly more weird than probably anyone out there. I think that most people set it up, set some rules in place, and then just kind of put it on autopilot as far as how you approach it, how you think about it. It could be value, it could be trend, it could be buy and hold. It doesn't matter. It's the weird behavioral stuff that mucks it up. So coming into the election, I guarantee you the things that people spend all day reading about and caring about aren't going to have an impact. But the things that will have an impact, are kind of always the boring stuff. Like nobody wants to think about accounting and taxes. That having been said, I will say, on the prediction markets, I have my money on this not getting called. A lot of people assume this is going to be buttoned down in November. No way. It's like a 5 or 10% chance this lasts into December. I like those odds. I think it's higher, like 30%, maybe 50%, all these mail-in ballots, you crazy. So I'm betting that regardless of who wins, and by the way, one of the biggest, weirdest parts of 2020, irregardless is now a word. So 2020, all the rules are now gone. So I can even say regardless, irregardless, I think this doesn't play out till December. It's likely to see a lot of volatility. Need to have a plan in place, whatever that may be. If things go haywire to the upside, if things go haywire to the downside. We've been talking a lot about the right tail, the left tail, protecting against both outcomes are certainly possible.
Thank you very much. What do you think, John, about if elections are going to impact the market, and how would you build your portfolio if you have to do it today?
That's an excellent question. Listen, the election, there's going to be a lot of volatility, as you saw over the last couple of days, with what's going on with Trump in the hospital, et cetera, or now he's out of the hospital. But I am of the view, or our firm's view, is preservation of capital is key. And we've been fortunate to win some mandates recently. And they asked us what we should do with the money. And what I told them, if it was my money, is to invest it slowly and to invest it over a 6 to 12-month period in kind of equal increments. That's how I would do it. I would use the volatility as your friend to try and take advantage of and getting some bargains. And if I was, someone building a portfolio from the ground up, that's how I would want to do it. And listen, if the worst case is you miss some of that upside, that's not so bad. You're getting some of the upside still by doing it this way. So that's how I would kind of invest in this kind of uncertain environment.
Thank you. What do you think, Michael? How do you see the elections impacting in the market? And how would you build your portfolio if you have to do it today?
If I had to guess, and I'm going to kind of go out on a limb a little bit here and make a more of a kind of specific market call here, but I think, once we get past the volatility, and I do tend to agree that the next few months could be pretty interesting. But once the dust settles, and regardless of who is, which party is controlling the White House and the Senate, which I think is frankly probably more important than the White House at this point, I think either way, the winner of the election is going to be inflation. Because I think either way, you have this kind of pent up demand for a second stimulus package, which is kind of on hold right now. But you see kind of both parties, and when the definition of a skinny stimulus plan is 500 billion or whatever it is, now pushing $1 trillion. These are numbers that 4 years ago, 8 years ago, even during the depths of the financial crisis, we weren't talking about stimulus of this size. And so with an economy which is showing signs of snapping back to varying degrees, but with the prospect of $1 trillion plus of stimulus coming, I think that's more likely than not only going to add inflationary stimulus at the that's a marginal at the margin a weakening US dollar, of course, all things equal, which they're not ever in the markets, but to me, I see inflation, and I see, kind of these, and we're starting to see signs of this, even in the past few weeks. But to me, that clarity of kind of who's calling the shots and who's kind of running the legislation, I think is likely to result in more fiscal response, which is going to add to this, this inflationary pressure, which we're starting to see. And so, again, you can pick your favorite, pro-inflationary beneficiary, whether it's small caps over large caps, whether it's value over growth, whether it's even banks. To be honest, there's not a purer expression than lenders of capital. And so, but to me, I see this. I would be surprised in. Regulation of big tech is another thing, which is kind of separate from inflation, but I think, regulation of big tech could surface regardless of who's in power. And so to me, instead of kind of calling the election, it's almost like, it's almost like a time series, so we get past this moment in time and then what's going to happen. And so that's my viewpoint. So not having a call on the election, but almost having a call on kind of likely events, regardless of the outcome of the election.
Thank you. Very quickly, Toby, because we don't have time. We don't have any time. Toby, give us your idea about how elections are going to impact the market, if they are going to do it, if you are taking care about that or not, and how you will build your portfolio in this time. Very quickly, please.
Yeah, I don't think that the elections have much impact one way or the other, or it's certainly not predictable how it impacts the portfolio. I would construct the portfolio the same way that I always do, which is looking out for building it from the bottom up, looking out for those individual businesses on a 3 to 5 year basis. If it's impacted by something political, then it's probably not investable for me in any case. I'm looking for things that are going to sort of muddle through they're really undervalued, that are going to muddle through for the next 3 to 5 years, maybe grow a little bit. And hopefully at the end of those 3 to 5 years, that value gets recognized and the portfolio as a whole does quite well.
Okay, so thank you very much for everyone here in this roundtable. We don't have any more time. I'm sorry. We have to end the meeting. I'm totally glad having you in this roundtable. I have learned a lot. I have to see it again and again to understand better and to go deep to the things that you have said, that because we have talked about a lot of things and very important things for the years to come in terms of investment. Thank you very much for everyone to be here, and I see you next year or wherever we can, all of them in Madrid, please.
Thank you.
Thank you, Lorenzo.
Thanks, Lorenzo.
Thank you.
Thank you.
Thanks, gents.
Thanks, Bye-bye.